If you're looking to buy a home in California in 2026, but you don't know where to start, this video is going to help you save months of confusion. I'm going to walk you through every single step in the process the way it should work, not the oversimplified version, and not the confusion 47-step process that you researched on YouTube and ChatGPT. By the end of this video, you're going to know exactly what to do, what order to do it in, and what mistakes to avoid along the way. I'm McCarthy, aka the Loan Guy, managing member and founder of Sceptre Mortgage at California Mortgage Brokerage. I've been helping California buyers navigate this mortgage process for well over 23 years, and now it's time that I help you. If you're ready, let's get into it. Know your numbers. Before you look at a single listing on Zillow, before you call a single realtor, before you do anything, you need to know 3 simple numbers. Number 1, your credit score. Pull your credit report right now on annualcreditreport.com. It's free and it's official. Your score is going to determine what program you qualify for and what interest rate you will get. We'll talk more about this in a minute. Number 2, your monthly income. And I mean your gross income before taxes. Lenders use your gross income to calculate something called debt to income ratio, or DTI. As a rule of thumb, most lenders want your debt to income payments, including your future mortgage, to be between 43 and 45%. However, there are loan programs that will allow us to go up even higher to maybe even 50 to 56%, depending on your credit profile and your FICO score. So if your total gross income is roughly $8,000, most lenders are looking for your total debt to be roughly about $3,600. If you get a program that goes to 50%, about $4,000 of total monthly debt. Number 3, your savings. And not just for your down payment, but your closing costs too. Most people forget about closing costs when determining how much they need to save for their house purchase. Most people forget about closing costs, but closing costs is usually calculated anywhere between 2 to 5% of the loan amount. So that means on a $600,000 home, your closing costs can vary between $12,000 to $30,000 in addition to your down payment. So you need to know these 3 numbers before you do anything else, because they will have direct correlation on what comes next. Step 2, get pre-approved. This step most first-time home buyers skip or do wrong, and this is the one that costs them the most. A pre-qualification is a lender basically taking your word for it for your income, assets, and debt, and they give you a ballpark figure. It takes about 10 minutes to give you and is worth almost nothing to most California sellers. A pre-approval is a real underwriting review. We actually look at your paycheck stubs, your bank statements, your credit report, everything. A pre-approval is what gets you taken seriously in this seller's market. In California, where competition is real and sellers get multiple offers on their property, showing up without a pre-approval is like showing up for a job interview without your resume. No one takes you seriously. Here's what you need to get pre-approved: 2 years W-2s or 2 years tax return if you're self-employed, 2 to 3 months of bank statements depending on the program, your California ID, and your social security number so that your lender can pull credit report. Understand, get this done first. One more time, get this done first before you fall in love with a home. There's nothing worse than falling in love with a home that you do not or cannot qualify for. Step 3, choose the right loan. Once you get pre-approved, your mortgage broker will present you with multiple loan options. Here's the plain English breakdown of the most common options. FHA loan, backed by federal government, minimum of 580 credit score, 3.5% down. Mortgage insurance is required and stays for the life of the loan unless you refinance. Great for buyers with lower credit scores or limited savings. If you have an FHA and your FICO's lower than 580, you may still qualify, but you can now have to put more money down. Instead of 3.5%, it will go up to a minimum of 10%. You can still qualify, just a little bit more out of pocket. Conventional loans, not a government-backed, typically requires 620 or higher credit score, down payment as low as 3% for the first-time buyers. Mortgage insurance drops off automatically when you hit 20% equity, better long-term for buyers with solid credit. If you have better credit, you want the ability for your mortgage insurance to fall off once you hit 80% loan to value, then a conventional loan may be the best choice for you. VA loans, exclusively for veterans, active duty, and eligible surviving spouses. Zero down payment, no mortgage insurance, one of the best loan products in existence. If you've served, you need to use this benefit. Jumbo loans, for California buyers purchasing above the conforming loan limits, which in most high-cost California counties is now over $1 million, requires stronger credit, larger reserves, and typically 10 to 20% down. Again, if you're going over the loan limit of a county, which is each county differs depending on where you are in the state. When you talk to your mortgage broker like myself, we'll let you know what that loan limit is. If it goes over by $1, you're now in a jumbo loan. Cal HFA or Cal HAFA programs, California's own housing finance agency that offers down payment assistance programs for first-time buyers who meet income limits, is worth exploring to see if you qualify. Down payment assistance may help you crack the barrier of lowering the cost of buying your first home. The right loan for you completely depends on your credit, your income, your savings, and your goals. What's right for you may not be right for the guy right next to you. It's exactly why working with an independent mortgage broker like myself matters. I'm not limited to one lender's program or products. I find the right one that best suits your needs. Step 4, find a realtor and start shopping. Now that you have your pre-approval in hand, it's now time to start looking for a home, baby. Let's go get it. Work with a buyer's agent who works for you, who represents you, and not the seller. In California, laws may have changed, but still, the seller typically pays for the buyer's agent, as long as it's put in writing. So there's no reason not to have your own representation at the table. A good buyer's agent is going to show you properties that match your criteria, including ones not yet on Zillow. Help you understand what a fair price looks like in your target market. Craft a competitive offer when you find the right home. Guide you through negotiations and contingencies and keep the transaction on track from offer to closing. When you find a home that you want to make an offer on, your agent and your mortgage broker need to be in communication. The offer letter, the pre-approval, and the closing date all need to be coordinated. In California, most deals include contingencies for lending financing, appraisal, and inspection. These contingencies protect you, so do not waive them until you understand exactly what you're giving up. Step 5, escrow, appraisal, and inspection. Your offer got accepted. Congratulations. You're now in escrow And this is where most buyers become anxious because there's a lot of moving pieces going on behind the scenes and they're invisible to you. So let me slow down and explain. This is what's going on behind the scenes. The escrow company, a neutral third party, holds all the money and documents. They make sure everything transfers correctly on closing day. In California, escrows is typically 30 days. The home inspection. You hire your own inspector. This is not optional. A licensed inspector is going to walk through that house, top to bottom, roof, foundation, electrical, plumbing, HVAC, and give you a written report. It typically costs roughly $400 to $600 and it's worth every penny. If they find a significant issue, you can negotiate repairs or credits or walk away entirely with no skin in the game lost. The appraisal. Your lender is going to order the appraisal on the property. An independent appraiser confirms the home is worth what you're paying for it. If the appraisal comes in low, meaning the appraisal says the home is worth less than your offer price, you have options. You can renegotiate the price, or you can make up the difference in cash, or you can exit the deal based on the appraisal, and again, with no skin in the game. While all of this is happening, your loan is in underwriting. This is the lender's deep dive into your financial file. They may come back with something called conditions, additional documents or explanations that's needed before they can make their final approval. Make sure you respond to these conditions ASAP. Every day lost is a day that we may run into potential problems going forward. Step 6, the final approval and closing day. You're now clear to close. The appraisal is cleared, your inspector has signed off, and now you're ready to fund. You're now in a home stretch, and this is how it ends. If you're dealing with a regular mortgage broker or lender, you'll receive the closing disclosures roughly 3 days before you close the deal. When dealing with me, however, you'll receive that closing disclosure well before the 3 days, so we already know what we're looking at. Make sure you read it. This is the final itemized breakdown of your loan terms, your monthly payment, and every closing cost. Compare it to the loan estimate you received at the start of the process. I will say this, the original loan estimate from the beginning will change slightly before we get to the closing disclosures, and the reason why is we have more details on the closing costs, what title truly is between your title company that you've chosen. The day before closing, you'll do a final walkthrough of the property. Make sure it's in the same condition as it was when you made the offer, and make sure that the agreed upon repairs were completed. On the actual closing day, you're going to sign lots of documents. Be prepared to sign, be prepared to have a hand cramp, be prepared to sit down for anywhere between 20 minutes to about 40 minutes, depending on your notary. This is where you sign all your loan documents. They're going to give you wire instructions to transfer the remaining of the down payment and closing costs. The exact amount will be on your closing disclosure. Once everything is signed, the lender funds the loan, escrow distributes the funds to the seller, and the deed is recorded with the county. And then someone hands you the keys. That's it. That's the whole process. Now look, every buyer situation is different. Your income, your credit, your target market, your timeline, it all affects this process. I love what I do. My name is TR McCarthy, aka TR the Loan Guy. I'm the managing member and founder of Sceptre Mortgage, a California mortgage brokerage. I help California buyers navigate this process from step 1 till keys are in hand. If you have any questions, call me directly at 888-488-5066 or visit sceptremortgage.com to get started. Subscribe to this channel as I put out videos every week to help California home buyers navigate rates, home purchases, ADUs, refinances, you name it, I put them on our channel. Drop your question in the comments. I read every single comment that comes in. See you in the next video. TR. the Loan Guy, signing out.